watch the third video of corporate finance. Today's topic is capital asset pricing model. I will use a bottom-up pedagogical method to present today's topic. Firstly, I will provide the definition of returns and the variability of returns of a portfolio. Secondly, I will describe the diversification effect in portfolio management. Thirdly, I will describe the efficient portfolio, which is the outcome of a complete diversification. And lastly, I will introduce the capital asset pricing model. Let's get started. Realized return. Realized return is the return that actually occurs over a particular time period. A special case is when you reinvest all intra-period payments, including both dividend or interest, in the same security. The realized return over the investment horizon T is like this. And this formula reflects a compounding effect. Then we also have the average realized return. So if the probability distribution of the return is the same over time, the average realized return provides an estimate of the expected return. Based on the average realized return, we can calculate the historical volatility. In finance, we refer to the standard deviation of a return as its volatility. The 95% confidence interval for the expected return is the average realized return plus minus 2 multiplied the standard error. And the standard error is the standard deviation of the estimated value of the mean of the actual distribution around its true value. So it is the volatility divided by the square root of a number of observations. Historical data shows that larger stocks have lower volatility overall, and even the largest stocks are typically more volatile than a portfolio. And this is due to the diversification effect, which I will talk about in the next slide. Relatively larger volatility means relatively larger estimation error for individual stocks. Therefore, the average return investors earned in the past is not a reliable estimation of the future. Furthermore, if we look at the volatility and return of individual stocks, we do not see any clear relationship between them. Thus, while volatility is perhaps a reasonable measure of risk when evaluating large portfolio, it is not adequate to explain the returns of individual securities. So now let's take a look at the diversification effect. So what is diversification? Normally, a security has both idiosyncratic risk and systematic risk. The averaging out of idiosyncratic risk in a large portfolio is called diversification. Idiosyncratic risk is security-specific risk, and the systematic risk is economic-wide risk. Diversification does not reduce systematic risk, so even holding a large portfolio, an investor will be exposed to risks that affect the entire economy. That is, the risk of recessions and booms, and therefore affect all securities. 3. Diversification can average out idiosyncratic risk. The risk premium of a security is determined by its systematic risk and does not depend on its diversifiable risk. That is, investors are not compensated for holding firm-specific risk. a two-step approach of measuring the systematic risk of a security. First, identify an efficient portfolio, which is a portfolio that cannot be diversified further. Then, calculating the sensitivity of the securities return to the return of the efficient portfolio, known by the name beta. The efficient portfolio is an important concept in capital asset pricing model, and we will make a deep dive into this concept later in this video. Now, let's take a look at the diversification effect explained in the language of math. Given a portfolio which contains n securities, with xi being the portfolio weight of security I, the portfolio's return equals to the weighted sum of each single security's return. The portfolio's volatility equals to the weighted sum of each security's volatility multiplied the correlation between the portfolio and this security. That is, the overall variability of the portfolio depends on the total co-movement of the stocks within it. Unless all of the securities in the portfolio have a perfect positive correlation of 1 with the portfolio, the volatility of the portfolio will be lower than the weighted sum volatility of the individual securities. But the amount of risk that is eliminated in the portfolio depends on the degree to which the stocks face systematic risks and their prices move together. In general, adding new investment opportunities allows for greater diversification. In the next slide, I will talk about the portfolio with the most diversification effect, the efficient portfolio. A portfolio is efficient if and only if the expected return of every available security equals its required return. The required return of a security I is the expected return that is necessary to compensate for the risk investment it will contribute to the portfolio. Here is the mathematical representation of the definition of required return. If the security's expected return exceeds its required return, then adding more of it will improve the performance of the portfolio and vice versa. The efficient portfolio reflects the equilibrium status when the expected return of every available security equals its required return. In other words, there is no way to increase the portfolio's expected return without increasing its risk. In the next slide, we will introduce the tangent portfolio and the efficient frontier. Before we do that, let's take a look at a widely used metric for measuring the risk-adjusted return of a portfolio, the Sharpe ratio. The slope of the line through a given portfolio P is often referred to as the Sharpe ratio of the portfolio. It is the portfolio excess return divided by the portfolio volatility. The Sharpe ratio measures the ratio of reward to volatility provided by a portfolio. Efficient frontier is the curve in the risk-return space with the largest expected return for each level of risk. If we look at the graph on the right-hand side, the blue curve here, it is the efficient frontier of risky investment. And the purple line here, which is also the tangent line to the blue curve, is identified as the efficient frontier, including risk-free investment. The point where the purple line touches the blue curve is corresponding to the tangent portfolio. Tangent portfolio is the portfolio on the efficient frontier of risky investments that generates the steepest possible line when combined with the risk-free investments. All efficient portfolios are a combination of the risk-free investment and the tangent portfolio. The part of the efficient frontier to the left of the tangent point, it corresponds to portfolios investing in both the risk-free investment and the tangent portfolio. And the part of the efficient frontier to the right of the tangential point corresponds to the portfolio consists of a short position in the risk-free investment and the tangent portfolio, meaning to borrow at risk-free interest rate and invest the borrowed money in the tangent portfolio. So all investors invest in the tangent portfolio. It means that the investor's degree of risk aversion determines the split of his or her investment between risk-free asset and the tangent portfolio. The capital asset pricing model uses the optimal choices investors make to identify the efficient portfolio as the market portfolio, the portfolio of all stocks and securities in the market. This is based on the principle of demand must equal supply. This model allows us to identify the efficient portfolio of risky assets without having any knowledge of the expected return of each security. The core of this model is that the market portfolio is the tangent portfolio. There are three main assumptions underlying the model. First, investors can buy and sell all securities at competitive market prices without tax or transaction costs, and they can borrow and lend at the risk-free interest rate. Two, investors hold only efficient portfolios of traded securities. Assumption 3. Investors have homogeneous expectations regarding the volatilities, correlations, and expected return of securities. The capital market line is the line from the risk-free investment through the market portfolio. Let's take a look at the graph on the right-hand side. CML is the efficient frontier, including risk-free investment, with the treasury bills being the risk-free asset and the market portfolio being the tangent portfolio. The model's equation for the expected return of any security I equals to the risk-free interest rate plus the risk premium of security I. And the beta of security I to the market portfolio measures the security's sensitivity to market risk because investors can eliminate from specific risk by diversifying their portfolio. Beta is the right measure of risk of individual securities. Thank you for watching. Have a nice evening.